What's up, YouTube? It's Todd here with Taste Tracker, and today I wanted to go over rolling options. There's a lot of questions I get around when should I roll, how do I roll, etc., etc., etc. So I'll cover that all today. So first of all, positions go against you. That's part of selling spreads, opening option positions, and even if you're trading stocks, but of course this doesn't apply to stocks, but a position will go against you. So learning how to manage that position only makes sense. You need to do that as part of your core competency. Otherwise, you're not going to be successful at trading. So rolling allows us to extend a trade or reduce a loss. So we're only interested usually in rolling a position that's against us. Of course, it is possible to roll a position that is in your favor. And an example here, real quick, is if you sold a put spread, that means you want the stock to go up, and the stock does go up. It goes up $100. You might want to consider rolling that up to collect additional premium with the anticipation that the stock will continue to go up. But that's not usually how we use it. That's not really managing. That's trying to squeeze more money out of a trade. Specifically here, we're talking about managing losers. So for this discussion, we're going to go with the classic example of how I trade. I'm going to try to keep this as general as possible so that everybody can benefit from the discussion. But typically speaking, I have $5 wide put credit spreads. So I sell a put spread or vertical, whatever you want to call it, with the anticipation, again, of the stock going up. And very commonly, I'll do that for $5 wide. I don't believe in selling things less than $5 wide. So that's my classic example. However, again, most of this will apply, and I'll try to relate it to any type of option position. So for example, here, we could roll up and keep the same expiration. That will give us more credit. So that is the example that I just gave you, where you're still bullish on the stock and you think it's got a lot more room to run. The further away from at the money, the less the movement and the Greeks are affecting your option position. So if you want to keep that near at the money, of course that's riskier, but you can end up collecting a lot more credit. For this put credit spread, we could roll it down, and that would cost a debit. So we don't want to do this. That's specifically on the same expiration. The reason we don't want to do that is because it takes our position and it sort of just degrades the value. It reduces your net credit overall. And I get into that in a second here. So I'll just move on to the next one, which is rolling out. That's typically what you'll see me do 99% of the time, where I roll out to another expiration. And the whole reason I'm doing that is to give myself more time to be correct. I still believe in the position, and I want to allow myself more time to be correct because the stock's gone against me. It's gone down, gone through my strikes. Just because it goes through my strikes does not mean I'll get assigned automatically. Assignment doesn't come until later in the expiration cycle because there's still extrinsic value. So you're not very likely to get assigned early, but there's a higher and higher probability of you losing on that position as the stock continues to go down throughout the expiration. So you might want to roll it out. So rolling out, I try to always do that for a credit, but you will see me occasionally do it for a small debit. I really like to have that be less than $10 to roll it out if it is a debit, but obviously I'm interested primarily in rolling if I can get a credit. Then it's like a no-brainer. Why would you not give yourself more time to be correct and collect more credit? Well, I'll actually cheat here and give you a hint or an example. The reason you would not want to just jump right into rolling it out is because, say there's another 30 days left on your expiration. If you roll it out to, say, 60 or 90 days, the Greeks, for example, theta is really strong the closer and closer to expiration. So if you roll it out, you're really guaranteeing that you're going to extend your trade much longer than maybe necessary. So say I try to roll out, but it's only down a dollar or two below my strikes. Well, if there's 30 days, that's plenty of time for the stock to come up that dollar or two that I need, and then I'll be right back in business and be profitable and be able to close that position much sooner. However, the second I roll it out, now it comes up those $2. I still may or may not even be profitable because there's all of those other extrinsic value baked into that position. So you could actually be shooting yourself in the foot by rolling it out too soon. Okay, so let's go into the sub bullet points here. To determine if I want to roll it out for a debit, you have to consider your overall credit. So for example, if I initially put on a risky position, it was right at the money, so I'm getting something like $2 of credit for a $5 wide spread. Then I'm taking a $10 loss, so my credit is now $190. That's still really good for a $5 wide spread. Typically, I'm aiming for $160, so $190 is above the credit that I like to receive, and so that's not necessarily a bad idea. Let's flip this around though and say initially, instead of taking a $2 credit, I only took a $1 credit. So I had some really far out of the money strikes that I sold, thinking that this is a no-brainer. It's never going to come down this far. So I took very little premium. And so if I'm taking a $100 premium, that means I'm risking $400 to take in $100. Now, if it costs me $10 to roll it out, now I'm reducing that down to $90 and risking $410. So you can see here that it was a bad position to begin with, premium-wise, in my opinion. And then now you're accepting even less to roll it out for debit. So it really, if you can avoid it, obviously you want to. You don't always get the opportunity to roll for a credit. There's a lot of variables involved with everything with options. So that might be just because IV is higher at the moment than when you initially opened it, and that's one way that you can collect more premium by rolling it out. Okay, and so obviously I said rolling it out gives you more time to be right. So in every broker, it's a little bit different. The better brokers obviously will allow you to do this in one order, and it's very easy. So in Tastyworks, you can click one button and click roll, and then it will come up with your old expiration and then your new expiration. Now, by default, that defaults to rolling out, but you can also roll up or down in that same screen. With something like Robinhood, you can either do it as two separate orders where you just close the old position and open up the new position. That's a little bit more unpredictable because the price could move in the time between when you close the first one and open the next one. But that's essentially all you're doing. It is still possible to do it all in one order, I believe, in Robinhood. But my point here is that different brokers make it easier to roll than others. Okay, let's go to the next one. So all of those examples were talking about put credit spread. But here I'm going to get into some of the two variants, really. So when you have a naked put, so you sold a short put, that's sort of the purest form of options is selling a put. And the nice thing about that is since you're only dealing with one leg, it will allow you to roll out much easier because you only have to get filled on your first expiration and then on your second expiration. So it's two option contracts that you're filling. Whereas if you have a put credit spread, that's four contracts. The bought and sold on the existing position and then the bought and sold leg on the new position. The other thing is because on a put credit spread you have two legs that are sort of negating each other to a certain degree. When you're doing a naked put and you roll that forward in time, a lot of times you can even roll that down a couple strikes and out and still collect a credit. So that's basically never possible to do that on a credit put spread. I've done it before, but it's very rare. Typically, you have to get the same strikes. There's nothing dictating that you have the exact same strikes, though. You can roll out to any strikes that you want. It's just going to affect you might have an increase in collateral. For example, if you go from a $5 wide on your current expiration to a $10 wide on your new position, you can do that. but that might affect obviously the collateral and the premium you've collected. You can go up in the chain for a debit or a credit, depending on where you're at and obviously a number of circumstances. But my whole point here is that one benefit of selling naked puts is that you can over time adjust your position to be successful. So you could start off with a strike that was way too high. You collected a lot of premium on it, but then the stock goes against you. Then you roll it out, collect even more premium, and you roll it down at the same time, out and down. And so now you have better strikes, plus you collected more premium to increase your likelihood. Obviously, there's downsides with short puts where if you're in an IRA or something like that, you're going to need to have all of the collateral as cash, which is actually good because you won't get margin called. In a margin account, they won't require you to have enough money to actually buy the whole stock outright. So that's where people get into trouble, where they sell too many short puts, then the stock plummets or volatility spikes, and now all of a sudden they get margin called and they need to either close out those positions at an inopportune time or they need to deposit more money. That's all kind of a tangent. The point here was that the nice thing about short puts is you can roll out and down, and then the inverse for calls. Obviously, you can roll out and up if you need to, if they're short. For something like an iron condor, which obviously is a combination of a short put spread and a short call spread, what you want to do is, if the stock is falling down and it's pressuring your put spread, so maybe it drops through your sold put leg, then instead of rolling the put side down, which would actually cost a debit and increase your losses, you want to roll the call side down. And then if you do it that way, you're actually reducing your exposure on that position. So you're going to collect a credit for rolling the call side down. Depending on how wide it was to begin with, if you come down a little bit, it's still a very tight iron condor. If you come down for the strikes, the sold strikes, to be the same strike, then it's an iron fly. And you can even go inverted, where your put side is above your call side. That's potentially locking in your losses like permanent, but it's also reducing how much you would have lost. So it's kind of 6 of one, half dozen of the other, what you are placing importance on. And I can go into that in another video if you guys really are interested. But let's move on. Okay, so what are the considerations? The first thing I think about, honestly, is my allocation of that ticker. I like to stick around 10% or less per ticker overall. But sometimes, depending on how much free cash I have, I might go above that, or maybe I try to split $5 5% on the first expiration and then 5% on the next expiration for that same ticker. And if I'm doing 5% of my account per ticker per expiration, if I'm in that mode for that account, then I have to consider, if I roll this out to the next expiration, will it be above my allocation now for that expiration for that ticker? Again, that may or may not be applicable depending on the phase of my account. My accounts, they vary over time how much I'm allowing per ticker. But that's one consideration. Will rolling mess up my allocations? The other big thing is if you still believe in the position. If you think that it just needs another week or two, and I honestly believe that it will be fine, then doing a debit to roll is much easier to swallow, because although I'm reducing my overall premium I collected, that's better than losing. So I'd rather come out with a scratch or a small profit than a large loss, right? But the problem with this is you need to think realistically. Are you just attached to that stock? Maybe you thought it was a really good entry, but entries can be good, and then the market can do whatever it wants. So you have to really look at this objectively and think, is this actually going to win, or am I just attached to this position for some reason? If you're attached, honestly, it's best to just close out of the position because your head isn't where it's supposed to be. So so you need to think realistically. How far away is it from being out of the money if it's a short put? And what is the average amount that stock moves? So, for example, if a stock is moving $10 a day and I'm $20 off away from my strike, well, that's potentially 2 days away from being out of the money and profitable. However, if its average move per day is something like $1, then that's 20 days and I've only got 10 days to expiration. Well, that doesn't make a whole lot of sense, does it? So I either need to roll it out or potentially close the position, or maybe there's other things at play here like earnings or some announcement coming up or something like that I'm expecting that jump. But chances are if it has to move $20 and it's moving an average of $1 a day plus or minus, and I've only got 10 days left, there's no chance that I'm going to be profitable in that position. So I need to think about managing at that point. Next bullet point here is if it's a lost cause, generally I won't close out too early. So even if I'm 50% loss on my position, there are too many other variables and options to just say like that's too much, because I might only still be down, like I'm 5 strikes away, $5 away from being profitable, but because IV changed and this or that, it's showing a 50% loss. Those can still come back and be a winner, 100%. So not 100% of the time, 100% they can be winners. So I generally don't get too excited and proactive in closing out early. And a lot of times by that point, say it's a $5 wide, I would have to buy back for something like $4.50 anyway. So there's really only $50 worth of credit that I could get back out of it. At that point, $50 is a lot, but with the amount of money we're trading here, in the grand scheme of things, $50 is nothing. I'd rather let that on kind of as a lottery ticket, but again, letting these things play out like they're supposed to, you'll be surprised how many times it actually comes back into a point where it's now possible to roll for a credit, or it's now possible to close for break even or even a profit. Over time you'll see how many times these things come back. So it's a little bit crazy. So when should you be doing this? Definitely not until the month of expiration. So if I sold the March position and it's February right now, I'm not even going to think about rolling it, touching it in any form until March. That gives me still 2 or 3 weeks in the month of March. That will be plenty of time. I'm not going to get a sign that will mess up my trade or anything like that. 99% of the time, obviously it's possible. But so I'm going to hold off on touching it until the month of expiration. And then at that point, I'm still not going to force it. I'm going to start looking at, is it possible to even roll at this point for a credit? And if it's not, then I might give it a couple of days or a week, continually trying, once a day to see if I can get a credit. And I really don't force something until the week of, or maybe the week before expiration, where at that point I'm thinking about, okay, I have to manage at this point. Either I'm going to do a debit for a roll, or I'm just going to close out altogether, walk away with my $20 or $50 that was left in the position. Or at that point, sometimes there's nothing left in the position. You could walk away with $5. And at that point, I'm going to wait till the day of expiration to close out, because there's no downside. I've already lost all of my money out of that position. I may as well hold on to it. Yes, it's ugly to look at, and it makes you a little depressed, but who knows? Something could be announced and the stock could skyrocket and then be profitable. And we closed out early for $5 2 weeks ago. I would rather just hold on and again lose that extra $5, because there's really little risk there. Okay. So I do have a note here. Overtrading can make it worse. So you can definitely take a winner and turn it into a loser by either not closing at the correct percentage. So, we recommend closing at 50% profit. But if you hold on to that too long, that can turn it into a loser. Over trading it, over managing it, that can turn it into a loser. So with this style of trade, you don't want to overmanage. You want to sit back, let the probabilities that you entered at the time of the setup work out in your favor. Obviously, it doesn't always, and you'll have strings of losers here or there, but we want to overall let it do its thing. So just a couple notes here to remind you why you entered this position. It was risk defined for a reason. At the beginning, you chose to do risk define, and at that point, you're accepting the max loss as a potential. You knew that when you got into it. The percentage in the money is at the time of expiration. So that doesn't mean that the entire way through our holding that position, it's going to be profitable. We know right away that 99% of the time, as soon as we open a position, it is not profitable. So that percentage in the money is at the time of expiration, not any time before that. So when you think about that, if it's 40% at the time of expiration, it's going to be in the money. That means I have a 60% chance of it being right then, but not now or any time in between now and then. Only then is it a 60% chance of being a winner. So think about that for a second. But yeah, the last bullet point here is allow it time to work. It's common to be down a large percentage of the time. Again, I've said this many times here. I will open up a position and it could be down for 20 days straight. And then in the last 10 or 15, 12 days, somewhere in that is when it spikes up and I collect my 50% or more premium. And then I go to the next one. And that first chunk of time is there with you sitting staring at a red screen. And that does sort of stink. But, there are times when that isn't the case. But that's just this style of trading. So it's something that you sort of get numb to over time. In closing, I wanted to say the broker links are in the description. Do all the YouTube stuff. I do have a charts on Twitter and a Discord chat, which, if you've been following my videos, you may not be. I'm trying to expand all the things I'm doing, month over month, year over year, be doing more. And so Twitter and Discord are pretty new. And so if you've been following YouTube along and you're not involved in those areas, go ahead and check those out. And then Tasty Tracker, if you're coming from Twitter or Discord or something like that, and you're not aware of my site, that is free and allows you to track your own trades and see community trades. And then, of course, I have my own trades there for the pro tier. And then, as always, these are only my opinions. So if you have any questions, go ahead and leave them in the comments below. I respond to everything. But I think that really covers it. And let me know if you have any questions. Yeah, thanks.